So Mike Cass from SellersFi here. I'm the director of UK sales, looking after a lot of consumer brands across the pond as well. So thank you so much for joining. I've met a few of you today, and yeah, just keen to initially introduce you to my panelists here to my left. We're very fortunate to be joined by some of the top consumer investors in the country, nay, probably the world, I'd say. So really, really interesting, I think, to initially be introduced to Grace, and then if we go along, just tell us a little bit about yourself, your fund, and what you're doing, and then we'll start off with the questions.
Perfect. I like that we're continuing the British accents. My name is Grace Gould. I'm a co-founder and general partner at a fund called Touch Capital. We invest in consumer brands across food, beverage, pet care, and personal care.
Hi, everyone. I'm Anna Doherty. I'm a partner at G9 Ventures. Our mission is to invest in companies that empower consumers to live, look, and feel better. We apply this broad, better for you, better for the world thesis across both physical products and digital services and technology. We have over 60 companies in the portfolio, and we invest across the spectrum from a stage perspective, so anywhere from seed to growth.
Hi, and I'm so excited to be with so many women on an investor panel today. Yeah, so and so many female founders in the audience, so fun. I'm Kimmy, Scotti. I'm a founding partner of a firm called 8VC. We're New York, Austin, San Francisco. I spend my time investing in the overlap between healthcare and consumer, and across the spectrum from like consumer products to deeper tech on the healthcare side, and also across stages from seed to Series A and early growth as well. And so I'm so excited to be here.
Hey guys, I'm the co-founder and general partner of Blue Scorpion Investments. We're early stage venture capital investing in consumer brands. Some of our portfolios include Van Duven Ice Cream, 8 Sleep, Quip, and Boisson. Excited to be here. The only male VC. How the world has changed.
Hi everyone, Jennifer Mandelbaum at Halogen Ventures. I'm Senior Investment Director here. We're an LA-based early stage venture fund focused on female in the founding team. We invest in consumer tech and B2B SaaS platforms, primarily in seed, pre-seed companies, and opportunistically investing in A and B rounds. We have roughly 70 portfolio companies to date, and so happy to be here.
Thank you. So look, I guess there's no secret that the heady days of 2021 and easy fundraising at ridiculous valuations are pretty much behind us. But I think what's going to be really interesting is to hear from the panelists in terms of their focuses for the remainder of 2023. We're hearing some whispers that maybe things are getting easier out there. Hopefully that's the case. But I'd like to hear from you, Anna, first. About what your kind of focuses are for the rest of 2023, probably going into 24 as well. What are you looking for in the market, etc.?
We're I think we're in a pretty lucky position. I'm sure other panelists are as well, where our portfolio has held up quite well. So we're actively deploying capital. We're seeing a lot both at the early stage, so kind of net new businesses, really exciting founders, but then we're looking for pockets of opportunity also in growthier businesses that were maybe just overcapitalized or mispriced. So there's an opportunity for kind of partnership, we think, at the early stage and then at the growth stage as well. And kind of a theme that we've been spending time thinking about is this idea of quality over quantity. So fewer, higher quality purchases as the macro environment has changed and consumers have fewer dollars to spend. What are the pockets that are going to continue to attract demand? We're thinking about that across a few different areas, but the idea of sort of elevated essentials. So think about kind of Bobby and infant formula or athletic greens and VMS. Expert-led brands, so Dr. Becky Kennedy's business, Good Inside and Parenting is a good example. Westman Atelier, Gucci Westman's clean color brand. And then we continue to be excited about kind of some of these new luxury businesses popping up. So Kate is an example in our portfolio. And we think that Gen Z is really driving this. There's a super robust kind of resale environment for luxury items, and Gen Z are beginning to purchase luxury goods earlier on in their lives than previous generations. And so this idea of quality over quantity is something we've been spending a lot of time thinking about across these different pockets of consumer.
It kind of feels a little bit like a two-speed market at times in the consumer space. You've obviously got that luxury side of things that's doing very well, lots of big exits happening. What I thought was quite interesting actually would be to kind of drill down a little bit more into, like, are you thinking about the exit potential for some of the portfolio companies that you are investing in? You know, you're obviously looking at a life cycle of your fund, 5-7 years, whatever that is. But are you thinking about that as well when you've got your eye on what you're currently looking at? Kimmy?
Yeah, sure. I think this is a really interesting market, and I'm sure, like founders, we all hear a lot about there being a funding drought, right? You're starting to go out fundraising, and people are out there in the market saying that, oh, well, no one's really investing. And one, I think it's really important to debunk that. We're all deploying capital, we're all investing, and great funds with capital are investing. And so I don't think that you should be discouraged by the market that we're in. I think that we are holding investments for longer, and I think it's really important that you're really convicted in the companies that you're invested in, and you're supporting them through this time, which can be, very difficult, and maybe you're not seeing like growing valuations and up rounds or a huge appetite for acquisitions, but there are smart acquirers, and I think there's actually a lot of them here today. Large companies with big balance sheets who are looking for innovation coming from smaller brands, and I think this is actually a great opportunity to create partnerships that are meaningful for your companies right now. And we're doing that a bunch. Like, we're doing a lot of merging companies creatively in market, restructuring things creatively in market and privately, and also selling things privately. And so I think it's actually a great time for really creative deal making if you have the right team and right partnerships. You too?
Yeah, no, I definitely agree. I think, so our fund, we just invest in CPG brands, and our thesis is exactly that kind of the leading incumbents are going to need to continue to buy in innovation in the form of M&A, and we look for new consumer brands who are sort of filling those innovation gaps. And I think what's interesting in the kind of macroeconomic environment is that the CPG companies are continuing to make acquisitions, whereas, for antitrust or for whatever other reasons in the tech, it has slightly slowed down. And I think that it's actually a very interesting and exciting time to be a consumer brand who's operating in this kind of innovation space.
That's really interesting. Just as a slight aside, it kind of feels as if, at least for the moment, that IPOs are probably off the table for quite a lot of consumer because of maybe how some of them have performed. Don't know if you guys are seeing similar. So M&A feels like a really good...
Exactly. It's not a great time to go public. I think we can all agree. But it is a great time to sort of put your head down, focus on your own growth, focus on the strong unit economics that the market's going to want to see when it's time for you to go public, and really invest in that growth and the strong unit economics, and also look across the market with who's lateral to you and combine forces, right? If you're spending against your largest competitor and that's driving up all your marketing costs, should you be one company? And then in a year or two, then you can think about an IPO. Then you can think about, a more robust liquidity strategy. But I think that there's a lot of opportunity to be creative in this kind of environment, and I think that's great. I think it's actually great. I think we sort of the sun was shining on all of us for over a decade, a really long time, and for sure a lot of my investing career. And I think that this is actually the most interesting environment that I've been investing in over the last decade.
And I would just add to that, I think the repricing that's happening now is really healthy for the ecosystem. Like, I totally understand, I'm not a founder. I know it's a difficult time to be fundraising, but I think kind of valuations coming back down to earth and this repricing that's happening across the board is really, really positive for founders, for employees especially, and for investors.
Yeah, I also wanted to add that it's really, companies should focus on profitability, right? They should really focus on cash flow, because I think that got lost, and that's really important. Because focus on the fundamentals and everything will work out, because opportunities always come for acquisitions, etc. And if you're focusing on real growth, profitability, cash flow, then you're not relying on outside funding. You can sustain yourself. I think that's a very important fundamental change. People should really think about how they run their businesses. Like, people look at the bottom line much more now. You know, it's a very famous saying, revenue is vanity, EBITDA is sanity, cash flow is reality. And I think
love
that's
that.
what
I've
you
not
should
heard
do.
that before.
I want to echo what Gautam just said, is to focus on profitability. With the evaluations going on right now, we're seeing like valuations down 20 to as much as 60% in the past, I don't know, year and a half to 2 years. But yeah, I mean, focusing on profitability, trying to be more efficient with your cash, and extending that runway. Be very mindful of like how much you burn with what's, you know, the market environment right now.
It's the burn multiple, isn't it, that everyone keeps talking about now, that they weren't talking about in 2021.
I feel like we were joking about this upstairs, but like, don't raise money from us, even though we're not in the business of saying this, if you don't need to. Yeah. You know, and if you're going to partner with investors, really, really think critically, go back to first principles. How much money do I need to scale this business? What is the sustainable growth rate? And then thinking about price, you know, that being grounded in data, in terms of historical transactions in the space, where public companies are trading. And again, I think, you know, that's a positive, right? We don't mean this to be sort of like depressing about where the market is. We think that's really, really healthy as an ecosystem, and you've heard that from all of us today.
Actually, I think this is a really important thing that Anna's saying, and like worth really doubling down on. When you're picking an investor, you're picking them as much as they're picking you, right? There's a lot of investors in the market, and you should be really selective about who you're working with. And so while they're going through their diligence process and asking you a zillion questions, and you're showing them every detail of your business, you should also be asking them, how did they support their companies through the pandemic? Did they provide financing, for payroll when SVB hit the wall a few weeks ago? What did they do to help the companies that were already in the portfolio before you go and get in bed with them as well? Because that past behavior is going to really show you how they're going to treat you if something gets hard. How do you support companies when the market is tough and maybe fundraising dries up? You know, things like that. And so make sure you're asking them the hard questions. You're not asking anything that you shouldn't. You're asking basically the same questions you would if you were going to interview with a company that you were going to be working for, you know? So think of it that way, because this is going to be, it's like a marriage, you know, that you're really in with them, and you want to, you know, really ask a lot of questions to understand how they're going to support your business through difficult times.
I think that's a really good point. And also, one of the things which we've observed with our portfolio company is now more than ever, the world is getting more complicated and complex. So it's kind of having expertise on your cap table is kind of more important than ever to help kind of navigate some of these kind of, you know, supply chain, kind of inflation, all of these sort of questions as well.
And I think as a founder, you know, in the same way that investors do reference calls on you, do reference calls on your investors, because they will be happy to connect you to folks, or reach out to founders in your portfolio if you know them, and get an understanding of what it's really like to be in the weeds with them. Because as Kimmy said, this is, you know, a 7 to 10 year relationship. And so you really want to know who you're working with.
All very good points. So obviously do your research, make sure it's a good match. I think that makes a lot of sense. And obviously profitability, like on the debt financing side, everyone's talking about that as well. I think you know, we're not going to get away from that for a very long time. So strong unit economics, make sure that's hopefully, you know, going down to the EBITDA line at the very least, or you've got a plan to make sure that's better. I think we can all agree that's very important. So aside from those things, any investment themes that's interesting? Anyone on the panel at the moment? You know, there's obviously a lot of talk about, you know, circular models, sustainability, all of those types of things. You know, Gautam, you're looking at me.
Yeah, one of the spaces that's very interesting now is the non-alcoholic space. I think there's a big paradigm shift in how we're looking at alcohol. We always say that the future of alcohol is non-alcohol. I think a lot of people are moving towards that. And we're seeing a lot of venture interest in that space. We have an investment at Boisson, which is actually the first platform for non-alcoholic. They do all the e-commerce, retail, wholesale, etc. And as a category play, we thought that was the best space to be in. And we were lucky to have CAA and Pernod Ricard join us in that round. So it's been a very interesting, and we're seeing a lot of brands emerging in this space. So they're very excited about that space.
Boisson also has a great store on Bleecker Street, which I go to a lot.
Yeah, I mean, they have 10 stores now around San Francisco, LA, and New York, and opening Miami soon. And that's just the beginning. And I think every month we're seeing same-store sales up a lot just because the category is growing and more education. So it's going to be very interesting to see where that sector goes.
We're going.
Boisson, Boisson. Like in French, it means drink.
I still want all the alcohol in my drinks. I'm not ready.
Same. Likewise.
Just non-alcohol.
At Halogen, one most compelling themes we're going to be focusing on is the future of families. So that's anything that really supports families at home, work, and in school. We did our market research, and it is an untapped, overlooked $7.5 trillion market opportunity. Parents are desperate for easy-to-use solutions, affordable solutions. There are 80 million parents in America. 60% of households have 2 working parents. Family dynamics have changed. More women are going into the workforce, and we want to keep them in the workforce. And we also launched a survey last year to over 600 families across the U.S. last year, and we asked them asked parents for their biggest needs and their desires. And the results showed that 96% of families have some sort of childcare stressor. Parents are really, really desperate to learn how to manage home, life, work. And so this is something that we're really going to tap into in our fund.
As a working mom, and also we have another working mom on the panel. Are you also a mom?
I am.
We've got
2 kids.
3 mom investors on the panel. 6 kids between us. I think this is a category that's really important and really growing. And I'm on the board of Motherly. A lot of you probably, if you're other moms, you're all shaking your heads. Yeah. We did the largest survey of parents ever, of moms ever, last year. The year before, we just only beating ourselves the year before, et cetera. And the number one issue in households is childcare, and households where the mothers decide to go and be a stay-at-home mom. And we saw that number double year over year of moms who replied to the survey the year before. This year, twice as many moms had decided to stay home because of the rising costs in childcare. And so, I think we're seeing a lot of new companies in the space. I think costs are still really high, even with the new entrants into the market. It's just truthfully really expensive to care for young people. And so I think we're going to need to see real change, and also a lot of employers supporting this in a different way. And so it's, there's real asymmetry in how the costs of childcare affect women in their careers versus men in their careers.
Very nice. Thank you, guys. So we touched on valuations very briefly. I'll open the floor to this one. What do we think? Do we think that valuations are going to improve? There's obviously been 20 to 60% negative, possibly more in some cases. Valuations, loads of down rounds happening versus 2021. Do we think that they're going to improve?
I'm just happy. My focus is very CPG focused, but I can give the CPG perspective, which is we as a fund will always be looking to invest at a valuation which will track to the exit valuation. So for instance, if you are a food business, a sauce business, and the typical valuation you'll get is a 3x TTM, sort of trailing 12 months revenue, then we would look to kind of have that when we invest, because we wouldn't want to see a valuation compression between when we invest to the exit. I would say one thing which we're seeing and will be the case more at the growth stage, and which we're seeing because we are very close with the potential acquirers of our portfolio companies, is looking more at EBITDA multiples. As well, and kind of companies needing to get to a kind of double-digit EBITDA percentage as they think about kind of getting a strategic exit. So I think from a consumer brand perspective, I don't see this changing because it's coming from the exit data. I don't know what you think, maybe beauty, skincare, I'm curious, your take.
No, we were just joking that we hope things don't change, right? We've talked about this being a return to normalcy, what's happening now, right? And you're just comparing it to a period that was completely out of touch with reality. And so all of the things that we've talked about, reasonable expectations for growth, profitability, grounding price and valuation in historical precedents where public companies are trading, all of those things, making data-driven decisions on fundamentals is really, really positive. And so I think that those kind of percentages can sort of skew the reality, which is this is a return to normalcy, and the 3 to 5 year period we were in prior was the anomaly.
I totally agree with you. And I think, Grace, I think what you're saying is really smart. You have to underwrite businesses in relation to where you think the exit values are going to be. And we were underwriting insane exit values before because the market was really frothy, and that's really changed a lot. But I think it's actually better for founders. And where we're really seeing this question come up is with our investors. So like the investors in funds, the LPs in funds are starting to look, sort of pierce the veil through to the investments we're making and ask questions about how we're thinking about valuations and how we're valuing companies both in the past and now. And I think that we're seeing, funds that maybe had really unreasonable ways that they were managing these valuations, not raising funds the same way, not hitting their hard caps, et cetera, in these most recent raises because they're so underwater in their previous funds. And I think that it's going to keep the investing community more honest now that we've seen, these funds like not get properly raised, basically.
And the other thing I would add, I think that like 2023, 2024 vintages for venture funds will be much better performing than the last, probably 10 years, the best performing funds of this decade, just because for all of the reasons we just described. And as investors, I think that's really exciting.
Yeah, and also like people are not really running to pull the trigger these days. So, you're seeing a lot of people waiting and taking time. And that means there's no rush into like, we need to get into this deal or everything. There's a lot of wait and hold period, a lot of much more further analysis into companies before those decisions are made. And things have got back to more reality, but honestly, it has come down a lot. Like we're seeing 2 times trailing 12 months revenue as well, where we are like pulling the trigger now, just because, capital is scarce and we want to invest in the right founders. And the other metric we're looking for is that our capital should be fully doing the round and not just waiting for other capital come in, because that's very uncertain. And the other thing is that we want to show that our capital will bring it to profitability. Most of the brands we're going to invest in, because those metrics are going to be more important to get better valuations, because it's going to be a huge difference between unprofitable and profitable brands where you're going to see valuations. So those things are going to be very, very important to look at.
I would say also, though, we as a fund are investing right now. And I think I've definitely seen, there was a period where I think I saw less transactions happening. We only launched our fund in 2022. So we have 10 portfolio companies now. We are doing 2 investments this week. I actually just organized a wire from the cafe over there. So we're going.
Capital's not that
but
scarce. I think,
but
not that scarce.
Yeah, but money is available. And I think kind of it's always hard. Like, I had a venture-backed business before I'm starting this fund. And I think fundraising as a founder, like nothing is more grueling and awful, like truly. And I really do appreciate that. But I would say kind of the market is open and transactions are happening.
And I think this move away from a free money environment is really kind of positive for the ecosystem in general, as we've said, because instead of value accruing to people who are the best connected or have the ability to fundraise and tell their story in a really positive way, value is actually accruing to the best founders, the best management teams, and the best businesses. And so we're all actively investing, and so come find us after the panel if you're interested in chatting.
Yeah, we're all investing. I'm not trying to scare people.
Yeah. Also, I do both. I both build, as you guys know, and invest. And I just closed a Series A for one of my companies 5 weeks ago. And so it's happening. Don't let the news scare you. The news is scary because of clickbait. It's not scary for you. It's not real.
So we've got a fantastic brains trust here. They're all confirming that deals are there to be done. There's money out there. I think let's try and be positive and think about things in a way that just makes positives out of situations. I think a lot of really good businesses are getting built at this time. Focusing on profitability is super important, of course. But what would your top piece of advice be to a founder who's maybe out there in the market at the moment, possibly struggled a little bit? What would your top piece of advice be to them to increase their chance of a successful raise at this particular time?
I just think just keep going. I think it's tough, but just keep going and really focusing on. It's so hard to say. Focus on being profitable when you're looking at your numbers, and it's like, well, where do the cuts come from or the revenue growth come from? But I think within consumer brands, I think really thinking about a strategic retail rollout can be very helpful and beneficial in terms of kind of growing your revenue in a more cost-effective way. It doesn't have to just be D2C acquisition.
Don't raise if you don't have to, and if you are going to raise, as we've talked about, ground kind of decision making around round size, growth expectations, valuation expectations in fundamentals and data, and then find investors that are really, really interested in what you're specifically doing. And at their early stage, that could even be angel investors. There's interesting syndicates out there. There are crowdfunding platforms. There are sort of alternative forms of capital than just sort of traditional institutional VCs. And traditional institutional VCs, that's the right option only for a really, really small percentage of businesses. And so I think really being honest about what your capital needs are and how you want to grow your company in a sustainable way.
I feel like I have so many things I want to tell you, but I think probably the most unique is try to figure out the story you're telling in the year you're fundraising. So some years are years for innovation and you're building new product. Some years are growth stories and you're getting a lot of new customers. Some years are margin years, right? Where maybe your growth is flat, but you're building margin and you're like, oh, last year we were at 12% margins and we're building up to a 60% margin, and that's been my focus. And I've been cutting costs and cutting team and moving around distribution and whatever. And so figure out what story you're in and really nail that. If you're trying to tell all of them together, it's convoluted and messy. And then they're like, well, why didn't you grow enough? And why didn't you fix your margins? And why didn't you innovate on anything, right? And so really figure out what sort of the path is. This year you innovate, next year you grow, the year after you fix your margins, whatever it is, and really focus on those storytelling principles. And if you can do that, and I think you can tell a really strong version of any of those stories, actually. And so I would do that.
Yeah, I would add to that, just get a handle on your whole business in terms of the costs. Understand all your costs, all the headwinds that can possibly happen, how you're going to navigate through that. If you're not profitable, have a clear path to profitability, because it's very unrealistic also early stage brands to be profitable. But if you have a clear understanding, you can convince the investors why this will be profitable, that's going to be very important and go a long way. I would add those things.
Yeah, I want to echo what Anna had said earlier, but fundraising, just be patient. If you you don't have to raise, don't raise. But what Anna said earlier is look at alternative paths to getting funding. Angel networks, high net worth individuals, those types of investors can make decisions faster too. I would also, consider taking every check. And taking as many meetings as possible. We've seen this where our founders talk to a prospect investor who may not be interested in investing, but they know someone else that's looking for a deal or a company like theirs, and they make those intros. If it's a good meeting, they love you, they will introduce you. And also, lastly, your biggest cheerleaders, some of them are on your cap table. I would focus on them. They will be happy to make introductions for you.
Perfect. Well, we are pretty quickly running out of time. I just want to say a quick thank you so much to our panelists. As I say, really top quality brains trust in the consumer investing space. Some incredible insights from everyone. And I think one thing to leave you with from me is every time there's a tough part of the market, the businesses that get through that to the other side when things get a little bit easier again, they tend to be the category defining, the category winning businesses. So if you focus on that, you understand your unit economics, you understand your story and how to sell that to investors. I think you're on a pretty good track, and you never know. Maybe one of these 5 here will be there waiting for a check with you. So thank you so much, guys, and enjoy the rest of your day.